Hey, good morning, everybody. I'm Chris Hanson, founder of Hanson Capital. I want to thank you for choosing to show up today. We're glad you're here. I've got Ted Oss, Managing Director of Acquisitions with us, as well as Chris Pike, Ted, Managing Director of Investor Relations, Chris Pike, Managing Director of Acquisitions. This is our second educational webinar, building on the one we did in December, where we explained how private equity real estate works. Today, we're going to go one level deeper, diving into understanding risk in commercial real estate. Specifically, how professionals think about it, how we price it, how we manage it. Today's webinar is for everybody interested in understanding the more comprehensive side of investing that often doesn't get talked about. Most investors know that something could go wrong, but don't have the framework for thinking about what that is. It's human nature to focus on the good and be optimistic, which we are, but we also want to understand and be realistic about the downsides. Myself, having a background in banking before starting my real estate career has led me to not always have the rose-colored lenses and be really in tune with what can go wrong, similar to how your bank would look at it. If you want to invest with your eyes wide open instead of just trusting projections and pro formas, you're in the right place. We also like to keep these interactive, so any questions or comments, put those into the chat box and we'll hit those at Q&A at the end. So let's start with the reality of risk. It often gets glossed over. There is no return without risk. It's just what type of risk you're taking in pursuit of those returns. How we understand what risk we're taking is by making sure we're looking at the right parts of any deal and asking the right questions. The closest thing to risk-free in the conventional sense is thought to be U.S. Treasuries. I won't sidetrack us with whether those are truly risk-free or not today. But in this discussion, when we're talking about the risk-free rate, that's what we're comparing to as treasuries. Common theme within commercial real estate is that margin of return above the risk-free rate. So the wrong question is this deal risky? The better question is, which risks are we taking? Are they intentional? And are we being paid to take them? Professionals don't avoid risk. They just navigate it and choose it more carefully. We also like to focus on risk-adjusted return. And what I mean by that is you can't just look at the upside of it. You also have to focus on the downside. If there's two scenarios, choice A, you make $20 or you make $10, and choice B, you make $50 or you lose $20, those have a very different risk return profile. We want to make sure you understand those so you understand what your range of outcomes can be. Today's plan, we're going to cover four things: what the types of risk are that we focus on the most, how we analyze those and how the professionals are mitigating those risks. And then lastly, we'll give you a checklist so you can use that on any deal. By the end, you should feel a lot more confident asking the right questions when you're assessing opportunities, and hopefully feel more confident going after deals in general. Before we dive into market risk, we need to start with, I believe real estate at its core fundamentally relies on supply and demand. It's one of the simplest macroeconomic principles. Think if you have 100 houses and you've got 100 people in that market, it's balanced. If you add another 100 people, your supply demand is going to be imbalanced. Those 200 people are now vying for the same 100 homes. Rents are going to go up, values are going to go up. Conversely, if you have the supply side or the demand side shrinking because you lose population, it doesn't really matter what your rents or rates are because you're going to have less people and you're going to have more inventory. That balance is what we're focused on entirely. When it comes to market risk, we can't really control the markets but we can control the markets we invest into. So markets really start with local market dynamics, not national headlines. We look at keeping that supply and demand lens. We're going to start with the population growth. If a submarket population is declining, all real estate's in trouble with rare exceptions, but we also want to dig a little deeper into what exactly the supply side looks like. Today in Phoenix, the industrial headlines are going to be somewhat negative that vacancy is rising and it's at almost a 10-year high right now. But we really need to look at what the product type specifically is. Big box, which we've built a ton of it for these distribution centers and the leasing velocity slowed way down, versus infill, land constrained, small bay product, where there is no new supply coming on and you're still seeing rents rise. And the other factor we consider there is going to be the new construction pipelines. If you've got a bunch of new supply coming online and you don't have the demand drivers that are going to support it, you're going to end up kind of getting behind that eight ball. You'll have declining rents, declining values. So we really apply that supply and demand lens with everything we are looking at in real estate. And then when it comes to the local economy, if we're talking about Phoenix, we're really looking at job drivers. We've got the TSMC or Taiwan Semiconductor plant. That was going to be a $65 billion project in Phoenix. Recently, they've more than doubled the fab size, and now they think it's in excess of a $200 billion development project. Just the development of the project has something like 40,000 jobs required, and it's going to bring a lot of technical labor to Phoenix. And that's just one project. It's not even taking into account, those numbers aren't taking into account that there's a bunch of ancillary service providers and other things that are related to that. So when we look at local markets, we're looking for what's going to drive that population to go up or down. We can't control those things, obviously, but being aware is what keeps us ahead of the game. If you're looking at the headlines of industrial vacancy and not diving into that supply side, you could just totally miss it. So same asset type, but very different risk profile. Ted, go back one slide for me. We missed one. Here we go. So now we're comfortable looking at markets. Let's dive into the next biggest risks in commercial real estate. I believe debt is the single greatest risk in real estate beyond that market risk. Applying too much leverage and not being able to keep up in the debt is what crushes real estate deals. The 4 areas we're going to focus on today will be leverage. Leverage is an amplification of returns in both directions. We need to understand when to use it, how much is appropriate, and exactly how it moves it. So think if you're using no leverage, you're just going to pay cash for something, the yield you're going to get is exactly what the deal yields. A 6 cap with no leverage yields a 6% return. If you apply leverage, there's going to be an arbitrage. In theory, you're going to have your debt cost be lower than what the deal yields. Let's say you can borrow the debt at 5 and it's going to stabilize to an 8 cap. That 3% difference in arbitrage over debt costs is what creates our return. The higher the leverage we use, the greater those returns will end up being. Rate type, pretty simple one here. Really, the 2 main types that we're focused on are going to be fixed or floating. There's appropriate times for each. Generally, fixed rate's going to be more conservative. The variable stuff is going to have its place. It's going to have higher leverage, but it has uncertainty because your rate can change. As we saw from the last few years, the 22 through 24 rate hike cycle was the biggest in over 40 years. That caught a lot of people in variable rate debt that just assumed real estate debt was going to be cheap for a long time. And when it just skyrocketed, it blew up deals in a major way. You need to know when to use both types. Your bank will also help you because banks don't give fixed rate debt on major uncertainty deals. And fixed rate is usually reserved for those stabilized deals or really strong borrowers. Maturity is kind of our third thing we focus on. Maturity often gets overlooked, or loan duration. And when I say that, I mean, is it a 3-year deal? Is it a 5-year deal? We really want to make sure that aligns with the business plan. If you have a single tenant deal and you've got a 3-year loan and you've got a 3-year lease, you're going to have a really hard time refinancing that deal when there's 6 months left in the deal because the bank doesn't want to take that lease up risk or the uncertainty. So if you can get the deal that you have or your tenant in place to sign a renewal, it's going to be really easy to get a loan. So it's like one of those little gotchas that sometimes people aren't thinking enough on the way in, and it can come back to bite them. And then lastly, what we're going to focus on is loan covenants. Debt service coverage ratio, or DSCR, is what the yield of a property will put out as a ratio against what the cost of debt is. So you can have a covenant in your loan that says if you don't maintain a 1.25 or 125% of the debt cost, you'll breach that loan and breach that covenant, and they can accelerate your loan and call it for maturity. Occupancy covenants are in there. There's also guarantee covenants. These are things that people sometimes don't think about. You think if you're making your payment, on your mortgage, they don't care what your income at your house. They don't care what your income is. But on a commercial property, these covenants get tested on a routine basis. So if your occupancy slips or your debt coverage ratio isn't high enough, the bank can put you into special servicing or accelerate that loan, and it can really create a problem. In addition, there is recourse and non-recourse and how that ties into it, more focused in the development world. But if you've got a completion guarantee and a non-recourse loan, and for whatever reason you run out of money or don't complete your project, that non-recourse loan can flip into recourse really quickly. So key questions related to these debt topics would be: how much leverage is being used? Is it fixed or floating rate? What does the loan mature, and how does that align with the plan? If you've got a 2-year renovation plan, I would expect to see greater than a 2-year mortgage term, because sometimes things happen that are outside of our control, and that can really create hiccups for you. We frequently try and get a couple of years post whatever our execution plan is worth of loan maturity so that we're never running up against that issue. Lastly, many problems in real estate don't come from the operations, they come from the bad debt structure at the wrong time. So when it comes to debt strategy as risk management is not just about getting the lowest rate. It's where we focus on that conservative leverage. We focus on the maturities being aligned with our business plan. And then flexibility is another thing that a lot of people don't think about. If you're just focused on rate, you'll forget that some deals will have a exit fee, or they'll have full yield maintenance, or different types of, I'll say, structures that don't allow you to just sell the building and pay it off whenever you want. When we're talking about yield maintenance, that means we might take a 5-year loan out. And if somebody shows up and wants to buy it at year 2, you have to make the payments of the entire 5-year duration. Usually they'll let you pay off in like a 6-month window near the end. But people sometimes think, hey, this plan's set in stone. We've stabilized this deal. We're going to cash flow it. They'll take out a full yield maintenance loan because the rate is lower. And then something will change and they can't take that opportunity that showed up because they've locked themselves into a structure that, while it looked good on the way in, it wasn't as flexible as they wanted, and it could create problems on the way out. An example where we kind of put this stuff into practice is we closed on our McKemmy deal in Phoenix, or in Tempe, in August, and then we also closed on a deal in Houston. Both deals require a lot of work, a lot of renovation and lease up risk. Me as a sponsor, I signed a personal guarantee which allowed our banks to give us full fixed rate and a long 5-year term, despite both deals only having 2-year execution plans. We're able to achieve fixed rate debt at a lower rate, which allowed our deals to create a better return. And it didn't harm the deal because I just guaranteed it with my balance sheet. So there's a lot of factors that come into making sure we manage the debt properly. And you want to make sure it's not just going to apply for a loan that covers the loan amount we need. As I wrap that up, I'm going to hand it to Chris Pike to dig into some of the other risk buckets.
Thanks, Chris. So I'm going to start talking to you guys through tenant risk as well as lease risk. Starting with tenant risk, you got to look at the tenant credit quality and understanding whether it's a small local mom and pop type of operator versus a national credit type tenant. And it's not as simple as just looking at, hey, do they have multiple locations across the country? You really got to dig into financials and understanding the staying power of a tenant and ensuring your ability to enforce guarantees on a lease, because a tenant with multiple locations doesn't necessarily mean they have strong financial backing or a strong ability to maintain their obligations per the lease. In addition, you're going to want to look at your single tenant versus multi-tenant risk. A single tenant is more of a all or nothing type of setup. You may get a stronger credit tenant in a single tenant deal, although you still face some risk as if they leave, you lose 100% of your revenue, as I mentioned, that all or nothing type of scenario. On the multi-tenant investment side of things, you do get a diversified rent roll, which limits your concentration risk, right? It's not the all or nothing setup as a single tenant deal, but there is operational risk associated with it. There's a much heavier lift in operating a multi-tenant structure or a multi-tenant investment. And so you want to ensure that you have the right team that has expertise in operating these types of business parks if you're investing in a multi-tenant deal. Next, I'll touch on lease risk. And lease risk is the risk associated with the lease documents themselves and the terms involved in them. You need to look at the length and term of a lease. You need to understand whether or not there's renewal options, whether there's rent escalations or termination rights for the tenants, right? You want to ensure that the current in-place leases on a property that you're looking at acquiring has the proper structures that allow you to execute the underwritten business plan. In addition, when you're executing your business plan, you want to make sure you structure the correct lease types that are appealing to the greater market in general, right? You want to set up the right lease structure that makes your asset as appealing as possible to the back end buyer, and you can successfully exit your investment. Next, I'll talk you through execution risk. And an easy way to boil down execution risk is to simply understand how complex the business plan is. You need to ask yourself, hey, is this a stabilized cash flowing investment or is it capital improvement heavy? And an example of this, or two ends of that spectrum, would be a development deal versus a stabilized cash flowing deal. Right? Both can be very acceptable business plans, but the compensation for each should be very, very different or drastically different. A development deal, you're taking on significantly more risks, so your compensation should be much greater than if you're investing in a stabilized cash flowing deal. Another item to consider when you're looking at execution risk is understanding if the underwriting relies on aggressive rent growth assumptions or major market rent growth assumptions. Right? These assumptions may be very valid, but someone who's banking on, continued rent growth within a submarket should be compensating you significantly higher for taking that risk on banking on those assumptions versus someone who's underwriting existing market rents with no growth assumptions. Again, to wrap it up, a good way to look at it is the more heroics required in a deal, the higher the execution risk. And the fact that simple business plans tend to outperform or survive better in tough market cycles. Operational risk is something that is frequently overlooked. Operational discipline is also something that you need to consider. You can mitigate operational risk by making sure that your team has expertise in managing this asset class and the business plans associated with what you're looking to achieve at an investment. You want to have consistent and repeatable business plans. You want to ensure that when appropriate, you're phasing in capital improvement plans over time rather than doing them all at once, and ensuring that you have adequate capital reserves, not only for operations, but ensuring that you have, excess reserves for your improvement budgets. Because as we all know, construction plans typically don't go exactly as planned, the timing, the cost. So you want to make sure you have the right contingency plans or the right budgets and reserves for both operations as well as capital improvements. Finally, you want to ensure that you have a strong property management team in place or a strong property management partner. Again, executing the business plans requires a team and strong partnerships in order to execute those plans. And again, an easy way to look at this, boring operations done well can reduce risk significantly versus something that has, a lot of heroics in a deal like I mentioned previously. So next, I'll talk you through sponsor risk. Sponsor risk is often the most underappreciated, but a very, very important risk to assess. In assessing a sponsor's risk is going and looking at their track record, not only understanding what they've done, but what they've done in different market cycles, right? Anyone can produce a great result in a great market. You really want to look at how has this sponsor performed in a down market to understand their true track record. Also, you want to have transparency and communication, right? What kind of communication are you receiving? How frequently are you receiving it? And are you truly getting insight to progress on the business plan compared to initial underwriting? Next, you want to look at skin in the game, right? And that's real co-investment by the sponsor or the operator. For example, an example of this, or what we consider significant co-investment, in our most recent deal, the Murphy Business Park, Hanson invested personally over $2.5 million on a $17 million raise. And that's, call it, roughly 15% of the total raise. This is something we consider significant skin in the game. When your sponsor has significant skin in the game, you can feel better about the fact that they truly believe this is a good deal and the fact that they're going to be paying attention to the deal during execution of the business plan and making sure things go as planned. Next, you're going to want to look at the depth of the team. A deal is not dependent on a single individual, no matter how much you trust that individual. To execute a business plan, it relies on a full team. So you want to understand the team that's in place and their ability to execute the business plans that are underwritten. To wrap it up on this topic, a good deal with a weak sponsor can quickly turn into a bad deal. Experienced sponsors tend to outperform new sponsors. That's not necessarily fair, but experience tends to outperform novelty in the long run. So how do professionals analyze risk? Right? Professional investors don't just look at one case or one underwriting scenario. They're analyzing upside. They're also should be hyper-focused on downside or downside risk protection. And you can do that by stressing NOI or income durability. You can stress vacancy rates or increases in vacancy, rental rates softening, expenses increasing. You also want to look at stressing exit cap rates, right? Changing your exit cap rate assumption could significantly change the outcome of your investment or your returns. So you want to model or stress test by modeling higher exit cap rates to ensure how fragile a deal may be, right? The goal is not to predict the future necessarily. It's just understanding the variability or the fragility in your underwriting. So at the end of the day, as Chris mentioned earlier, no deal is absolutely risk-free. You're just choosing the mix of risks that you're taking and how you're getting compensated for those, right? The goal is to avoid taking too much risk or not getting appropriately compensated for taking the risk that you're selecting. With that, I'm going to hand it over to Ted and he can wrap up the presentation for us.
Thank you, Pike. If anybody has any questions or comments, you can feel free to add them into the chat. We have a few here and we plan to go till about 11:30 Arizona time. We can go a little bit longer, but happy to answer any questions you might have. So at the end of the day, it's about alignment. If you don't have alignment with your sponsor, you probably shouldn't invest. So what you should look for in a real estate sponsor, meaningful general partner co-invest, which is how much of their own money are they putting in the deal. You want fair and simple fee structures. They should be straightforward and easily understood. And you want clear communication and reporting What is the cadence? How often should you expect to hear from them? Setting the expectations ahead of time will give you peace of mind later. As an investor, you should feel comfortable asking your sponsor you're interviewing the following questions. How is this deal stress tested? And then where do you see the real risk? If a sponsor can't clearly answer those or gets defensive, that's typically your answer. And then clarity will build trust, and vagueness should raise red flags. A couple questions that we came up with that every LP should ask and to help their chances of finding a successful sponsor and a deal. What's the biggest risk in this deal? How is the debt structured and why? What happens if we need to sell or refinance in a bad market? How conservative are the rent and expense assumptions? And then how much skin in the game does the sponsor have? If you can't get clear answers on these, you'll want to proceed with caution. And if anyone has any more, again, feel free to add them to the chat here. We'd be happy to hear about. So key takeaways here: obsess over the downside, bet on the team, not just the deal, and choose your risk wisely. You can eliminate risk, but you can choose it intelligently. Good sponsors obsess over the downside more than the upside. And remember, you're not just buying numbers on a spreadsheet. You're buying a risk framework, a team, and a decision-making process. So with that, I got about 5 minutes here. We're going to go into some Q&A. One of the first questions that came up, this would be a good one for Chris Pike. Chris, what market signals make you pull back or slow acquisitions in a sub-market?
Yeah, I think this would most likely go back to what Chris was talking about towards the start of the presentation and understanding market risk. Right, looking at supply demand dynamics and inventory that's coming in a market. If you see population declining, major red flag, and you may want to pull back from that type of market. Also, keeping an eye out on issues with oversupply, et cetera. So I think just the risk that you should assess most, or the most important one to look at, is the market risk and understanding supply demand dynamics through population growth, or looking at what the new construction pipeline looks like.
Chris Hanson, here's a good one for you. How do you balance being conservative without underwriting deals so tightly that it doesn't pencil?
That's a great question. I think read it one more time. Balance being conservative with what?
How do you balance being conservative with underwriting deals without underwriting deals so tightly that nothing pencils?
Okay. One good way to make sure we're being conservative is having the real skin in the game, as we mentioned. I'm making these investment decisions with my own dollars, meaningful dollars to me in mind. And, we actually had a tough period from 23 and 24 where we just didn't see deals that did pencil. And I think that actually is a differentiating factor. Being able to say this doesn't pencil, it doesn't make sense, is difficult, especially when Chris Pike's team sees the volume of deals they do. It's pretty typical for him to see somewhere between 600 and 1,000 overall deals on a monthly basis that get submitted. I think he whittles that down to somewhere around 50 that are really worthy of underwriting. And I'll say he probably makes 5 to 10 offers a month, and I'm using very round numbers there, but to go from 1,000 at the top of funnel to 5 or 10 that are worth offering on, it's pretty common that we say no to everything we see, right? So we've kind of gotten used to it, unfortunately. There was a period in the 18, 19 where everything penciled. 20 was a scary time, but we bought into that market because we thought the fundamentals worked for us. So we continued to invest. That's worked phenomenally with our recent exit to JP Morgan. But I think that's the approach: is make sure we've got a comprehensive view, make sure that you're trusting the numbers. It's not an intuition game. We're following the data and sticking to kind of the rules and guardrails we put in place.
Here's one, Hanson, kind of piggybacking on that. What specific risks keep you up at night right now?
And see, these are great questions, and you want to see a sponsor think sincerely to these. Today, what's keeping me up is I see an environment going forward that could be extremely inflationary. The stuff this weekend with Powell and Trump going after each other. We know the administration wants to get lower rates. I would like to see lower rates selfishly. That stuff pushes towards an inflationary environment. But conversely to that, the employment and some of the other stuff that's pushing the other direction could be deflationary. So right now, I'm nervous purely in that I can see an argument or a case for we're going to see some values rise. I also see a case for values going down. I don't like that kind of conundrum of it could go either way. How I'm kind of positioning ourselves to go against that is, if I could sell everything today and have pure cash, I don't know what I'd do with it. So what I'm focused on is yield. We're leaning a lot more towards cash flow and yield than we are, kind of more speculative or growth creating deals. When it comes to, we talked about that risk-free rate at the start of my section. If my money market accounts or treasuries were going to yield, 4.5 to 5 earlier in 25, today I think those are yielding 3. So if I can buy real estate that'll produce a 6. Actually, a great example is our Murphy deal we just bought last month. In-place cap rate of a 6.6. We put that thing in escrow in October. We had 2 rate reductions since then. So we were getting about 150 basis point premium above the risk-free rate to own real estate. Conventionally, real estate guys want to see 100 to 150 basis points premium over risk-free rate. Well, we've had those rate drops since then. Money markets are now yielding 3s, low 3s. And we've got an in-place yield of 6.6 going in that stabilizes north of an 8. I'll take an 8 over being in cash and sitting on a 3, as long as we have some of those basics, like buying below replacement cost with some upside potential. I think that's a real easy place to sit, and we can weather both sides.
Mike, here's a good one for you. Project diversification, single multi-tenant projects versus multi-project and multi-tenant projects. Are these deals fund one single property projects?
Yeah, so I saw this question come up. I think what he's asking is, hey, can we diversify through our fund having multiple investments, single tenant, similar to the risk diversification that you're seeing in a single investment that's a multi-tenant asset? If we look at it from a perspective of our Fund 3, it's set up as a series limited LLC where you're truly just investing in a single deal, similar to a syndication. It's not the same as a traditional fund structure. So therefore, you are just investing in a single project typically. But when you're looking at it, you can invest in a single project and diversify your risk through a multi-tenant structure. You can also achieve that, though, I guess, David, to answer your question, if you have an investment that's a portfolio of assets that are single tenant assets, you can also achieve that same diversification just in a little bit different means. So there is ability to achieve it, but when it applies to our specific fund, our Fund 3 today, we're focused on single property investments that are multi-tenant business parks or alleviate that tenant, that all or nothing risk with a multi-tenant diversification in the project itself. And then if people are interested in getting some project diversification, we recommend spreading out your investments with us across various series within our fund. Hanson, I don't know if you have any additional that you want to add to that, but I think that's what he was getting at there.
Yeah, I think you nailed it. I agree. I would rather have a multi-tenant project today than even a pool of single tenant today. Yeah, I think you nailed it.
Hey, Hanson, this one's from Wyatt. What does your crystal ball say about interest rates this year with upcoming changes in the Federal Reserve leadership, and how important is that risk to Hanson?
That kind of piggybacks off the one I just answered. I would bet, if I were a betting man, I actually frequently say my crystal ball is broken. So that's interesting wording. I think we're going to see some rate reductions. Trump has put a couple guys on the Federal Reserve Board that have been, there's been some dissent in there, but I think the dissent has been, one of the guys he placed was pushing for 50 basis point reductions as opposed to the others at 25. And I know the candidates that are likely being considered, he hasn't announced his decision yet. I think we're going to see more rate reduction. With that, I think we're going to see a tremendous flood of capital into the marketplace. The deal that we've closed, for those unaware, those that are not already investors with us, we have an 8 property transaction we're closing with a subsidiary of JP Morgan. JP Morgan's the sole equity behind a industrial operator named Zenith. We closed 3 of those deals in December. We've got 5 more that are closing this year. They're thought to be one of the sharpest institutions in the world. Their 10-year long-term capital markets outlook that got published either in late November or early December last year said they put industrial and logistics real estate at the top of the pile, both alternatives and stocks and REITs. They see this as the opportunity. This fund that's buying stuff from us is tied to their core fund, which is interesting because the assets we sold them are kind of older. We like generic product that works for a lot of things, but it's not Class A stuff. It was a little surprising to see, a core fund acquire that stuff from us. I hope that answers the question. Shorter answer, I think rates will come down, but I'm hedging for both directions. And I'm hedging for that by using fixed rate debt.
Pike, here's one for you. How concerned should LPs be about small local tenants versus national credit tenants?
Yeah, this one comes up pretty frequently with our investment thesis of small bay. So it's a great question. It's really dependent on the rent roll, right? You got to look at, hey, if we've got a building with only 4 tenants and all 4 are small local credit tenants, and you have significant exposure from them vacating in the near term based on their financials, that's something you should be concerned about. But if you've got, 100 different tenants and it's a mix of small local tenants, some regional tenants, and maybe some national tenants, you got a little bit less risk there, especially if the small local tenants have, more sticky businesses or more enduring businesses, right? So it's a loaded question, and it really just comes down to number of tenants, the credit of those in-place tenants, and the concentration, or what percentage of the building do each of those tenants occupy to truly assess your risk that you're taking there. Because again, like a 1 or 2 tenant building with small local credit tenants versus a 100 tenant building has significantly greater risk, even though it's the same tenant quality across both assets.
Hanson, here's one for you. How do you want LPs to think about patience and time horizon when the market gets choppy?
Patience and time horizon when the market is choppy. I'm going to interpret that to mean kind of just unexpected market turbulence or something like that. Like the last couple of years, we had some deals that we're holding. Our thesis says we want to get to deals to a stabilized yield that we like. Our business model is not necessarily just a value add execution and an immediate resale. We're focused, which is nothing wrong with that business, but that's focused on transactions. I'm going to buy something cheap, I'm going to improve it and resell it. I like durable cash flow. I like ongoing consistent cash flow. So we're focused on yield. And as long as we're staying in line with that principle, if the market moves around or it gets odd, which it has been, like the last couple of years, it hasn't been the greatest time to sell assets. If we're focused on yield and we've executed our plan, we can afford to be patient and hold things. Our funds do have sunsets where it would require us to sell an asset. If we were having to sell into one of those choppy times, per this guy's question, I would go ask for time to extend if I felt it truly was the wrong time to sell. But, this uncertainty that we've had in the past couple of years, I think is going to lead to values going up significantly. A lot of money's been on the sidelines. And as that money comes back in the marketplace, it's just back to that same supply demand concept. There's only so many assets there. As more buyers come in, that demand side's going to rise, and there's not a lot of stuff for sale. So Chris Pike struggled on the acquisition side in these uncertain times because there's not a lot of sellers. So I think we just adapt to it. We would appreciate LPs being patient with, we know what we're doing, but this hasn't been an issue for us. We've never had LPs get upset with us over timing. We communicate quarterly emails to just give you an update on every project we own to our partners. And then we send off cadence emails anytime something meaningfully happens in between that. We also encourage our investors to communicate and reach out with questions. And some do, some don't. But I think this is something that's easily addressed. Sometimes when people are uncertain, they call and ask something. We explain why we're sitting or why we're waiting, and people usually end up on the same page.
Looks like we got one more question here, Pike. If I'm comparing 2 deals with similar projected returns, how should I choose between them from a risk perspective?
Yeah, I think an easy one to look at there would probably be just going back to my example of like understanding or comparing development versus a stabilized cash flowing investment, right? Looking at execution risk as well as like the sponsor risk and the team behind the sponsor, right? Is there heavy capital improvement lift with a lot of vacancy or a lot of construction where costs can shift depending on timing? Is there lease up risk, right? Where it's vacancy periods could get extended if things don't go as planned versus something that has in-place tenants with an average lease term of 5 years or greater, right? Those are 2 drastically different risk profiles. So just looking at those business plans and how much goes into each would be an easy way to compare it, as well as looking at the sponsor and their team and making sure that they have the right team in place to execute those business plans. That'd be an easy way to compare the 2.
I'll chime in on that one too. I would focus first on complexity because and not that he had the wrong answer, but just a simple takeaway, complexity. The fewer moving parts, I'd have greater certainty in it. And then lastly, I'd be focused on, like he said, the people involved. If it's somebody who's new in the business and trying to figure it out, I discount that, returns being equal. And one thing he didn't mention is I'd probably want to understand the underwriting assumptions, because if you show up, if you both have a 15 IRR, but one requires underwriting assumptions of rent growth, whereas the other guys are not trending anything like that, there's differentiation in the underwriting method. Is that it?
Yep.
All right. Well, I thank everybody for attending, and we will send a recording out in case you showed up partway or missed some of it. And we really appreciate this. This is the second of 12 part that we've got planned for this year. So we intend to continue to create content. We would love feedback if there's any topics or areas of commercial real estate that you would like to learn more about. We would love the feedback, because we want to continue to drive value for our partners and potential audience. Thanks, guys.